All right, guys, welcome back to another installment of the mentorship. All right, and today we're just going to talk about liquidity. All right, so the previous one was about ranges, and you would have seen the same looking chart here that I've got marked out. But today we're going to talk about liquidity and the three Trinity concepts of liquidity that I use personally in my trading, and that I'm trying to facilitate for you guys to also use. Now, you've got to remember that as much as, we said that market structure is number one, as much as ranges and understanding the structure of the market is your main priority, right? The second is liquidity, all right? And those two more or less go hand in hand. Like, the market moves based on liquidity, and, the way you're going to be able to facilitate trades and the way you're going to be able to form your trade ideas is by understanding where liquidity is and then looking at the market structure and understanding, okay, how am I going to get involved based on the structure of the market at this current time? Where is price within the range? And also, coupling that with liquidity as well. So, yes, today we're going to be talking about liquidity, guys. And I mean, just take what you can from this one. Anything you don't understand, make sure that you comment in our chat, make sure that you get involved with the community, and that'll make it a lot easier for you. But yeah, so we're going to talk about three types of liquidity today. So the first type of liquidity, guys, is liquidity above highs and lows, all right? And this is going to be the main one you use for your profit taking. It's going to be the main one you're going to use for targets. This is the bread and butter of how the market really moves. This is why you would get retail traders putting their stop losses, their orders above highs and lows, guys, all right? So liquidity, literally all it is just orders above and below the market, or orders that are residing in different places and spots inside the market as it is, all right? And the reason why price moves is because price itself is drawn to those liquidity areas. And the reason for that is because price is drawn to areas that are going to fill in the market makers' orders, all right? It's as simple as that, all right? The market makers push price up and down to literally fill in the orders in the market. That's their job. Their job is to facilitate trading. And to facilitate trading, they've got to fill the orders and pair orders in the market. That's all they're really doing. All right, guys? So in terms of this bit of price action we have here, right? What I want you guys to look at is obviously understanding the range and prices inside this range, right? But what causes price to move, out of this range and inside this range into different areas? And what we're going to do is, the first thing I'd always ask you guys to do, the first thing that I think you should always do when you're looking to trade or take a trade or understand where price is going to go, is mark out your highs and lows, guys. All right, this is most important. You've got to mark out your highs and your lows on your chart, all right? And these can be, the most poignant highs and lows, the high and over range, for example, like here and here, because price is inside this range, but also the highs and lows inside the range, all right? So we've got two highs here. And I want you guys to look at these. We've got a low here. Yeah? There's also another high there. I'm going to pull that one back into the range so you can see that one a little bit better. Alright, guys, so in this situation, right, in this bit of price here, I want you to look at the highs that are being formed, alright? So this is a daily chart. So if you're trading, guys, if you're an intraday trader and you're going to be following what I'm doing, then, you understanding the daily highs and daily lows are very, very important. And these are because there is a lot of liquidity above and below these highs and below these lows, right? A lot of liquidity, especially in the daily chart. There's tons and tons of orders above these highs. So when you see price making highs, right, like this, so let's say this bit of price hasn't happened yet. When you see price making highs consistently, and you see it in a down market, right, what is happening is that there is liquidity residing above these highs, all right? Even over here as well, all right? It's the same thing over here. Let me just draw a line over here so you can see too. Liquidity is above these highs, all right? And the reason for that is because, especially in a bullish market like this, people are going to have orders above these highs to go long, all right? That's how retail traders will trade. They will have buy stops above these highs to go long, and then most likely will have sell stops below these lows also to go short. All right, that's how they more or less trade. They trade based on breakout strategies. So they're looking for price to break out of the range and for them to go short. And that's how they trade, right? So the important thing to kind of glean from this is to understand. All right, if we've got highs that have been made on the daily chart, then we know that there's orders above these highs, right? We know that there's liquidity above these highs. There, there, here. All of these highs, you've got liquidity ranging above all of them, right? So we know with a degree of certainty that if price is going to go higher, where is it going to target? It's going to target these highs. All right, and the reason for that is because that is where the money in the market is residing. All right, these are the main points of reference for the market makers to push price and for price to be drawn towards. So when you're coupling this with market structure ranges, market structure breaks, break in price, break above a high, then you know exactly where price is going to be drawn to. All right, guys, this is the foundation to everything that we really do. It's the foundation to understanding where liquidity is. It's the foundation to understanding where price is going to be drawn to. So really, really study these highs and study these lows, all right? Do the same thing for the upper end of the market. See how price moves between these ranges, okay? So in this situation, we've got highs, and these are untested highs. So these are highs that have not been run. So the market has not run up to these highs yet, see? So it's made literally sequential highs or sequential lower highs. Now, when the market is drawn higher, these are the levels that I'm going to be targeting, period. All right, if I get a break in the structure, or if I get a break through a high and a retest, or a break and a breaker set up, for example, like this one right here, where is the next obvious high that's going to be taken out? All right, let's have a look. If I get in to a trade based on this breaker here, then where is the next obvious place for this price to reach for? It's going to be that one, isn't it? And as you can see, price broke above that high, retested, just about wick through it there. I'll zoom in for you. See, price just wicked through that level there. Then we had a down candle dropping back into this range, back into that breaker. And obviously that breaker acted as a pivot and price took out that high. And this is a daily chart, guys. So if you see this happening on the daily chart, then this allows you to have the framework to know where price is going to go before the fact. All right, guys. This is what helps me understand where price is going to reach for on the daily chart, on a weekly chart, on any time frame. It's the same concepts we're using. So in this case, you can see price drop back into the range. All right, it dropped back into this range between that high and that low, and boom, we got an expansion up, and we took out liquidity in that high. Same thing happened again. Once that high was taken out, we got to drop back into this range now. Now between that high and between this low still. It's because it's the most recent swing lows, swing high. Boom. Expansion up again. Where did the expansion come to? Came to this high right here, alright? So as you can see, we got an expansion through that high. Yes, price did come to bearish order block, and it dropped back into the range again. Similar thing happened again. Price expanded up, just was shy of that, dropped back into the range, all right, beneath that level, into an order block. Boom, an expansion up through that level there, all right? And it didn't just expand through that high, expanded through that high and that previous high too, all right, guys? So this is how we facilitate where price is going to be reaching for, guys. This is the main thing. Your highs and your lows are very, very important. If you understand and you have these marked out on your chart, it's a lot easier to see where price is going to be reaching for, and then obviously it's going to be a lot easier for you to formulate a trade based on our entry tactics. Okay, so I want you guys to understand this and just study. This is where the liquidity lies in the market. This is where you want to be targeting. All right, and that's the first concept of liquidity that I want you guys to understand. All right, that's the first one. Second one is going to be voids. All right, so voids and price are they're similar to highs and lows, right? The same thing is occurring in the voids of price, right? I'm going to just mark one out for you right here. So with voids, you have, these are usually long extended candlesticks or long extended segments of price where we have had a massive expansion to the downside, right? And this will usually be in the form of big candles, all right, or big long candles without any pullbacks without any interruptions. All right, so this to me is a void. Why? Because as you can see, we're comparing it with this bit of price action. You see price pull up. So you see white candles and black candles being made in formation. In this is just one big down move. You know there hasn't been any pullbacks on the daily chart inside the section of price. So in these situations, guys, we want to be targeting the range, okay? So it's a similar thing again. All we're doing is we're targeting the range between that high, that candle, all the way down to the low, right? Because all of this piece of price action, all of this segment of price is holding liquidity. And the reason for that is because when we have big down moves like this, guys, there are so many people that want to go short inside this range. And because price has moved so quickly, because there was just no pullbacks, whatever, people that were trying to short this and waiting for a pullback on the daily chart, they didn't get that. And as a result, they still have their residing orders inside these ranges, right, guys? It's the same thing. When people want to go long, they'll usually put a buy stop above the market, or they'll usually put a sell stop below the market, all right? It's a similar thing in these voids of price, right? It's a similar thing again. What's occurring here is that they are putting limits in these areas. And as a result, when price moves down, you guys know how limits work. For a limit to work, price has got to come up back into the range to activate that and trigger that limit. In these situations, there was no pullback. So there's going to be tons and tons of liquidity resting inside these daily candles, inside these daily ranges also. All right, guys? So that is why you see price showing a willingness to pull back into these areas, because there is a lot of liquidity in those areas that prices has not filled in yet. And usually, I have a rule with these segments of price, guys. Usually, what you want to see is you want to see price pull back into the fair value of these ranges. And fair value literally just means the 50% or the equilibrium of this range. So if we're going to pull our, let's just pull our fib from that high to that low. All right, guys? So we're going to talk about fair value. The way I target these ranges is that I usually have two methods, all right? So the first thing is that I'll mark out a range. I'll mark out from the high of that range, or usually maybe from the high of the candle, that range, down to the low of that range, all right, of the void. Okay, guys? And in this situation, what I'll be doing is I'll be targeting the equilibrium mark. So usually what the market makers will do is they'll pull price back into fair value of the range. And fair value, guys, is always 50%, all right? That's fair value, because it's the balance, it's the equal point in between the range, right? So when we have big voids like this, I will target 50% usually. And this will allow you guys just to have, this is the lowest, this is the absolute minimum. If you're trading ranges and you're trading gap fills, this is the absolute minimum you're going to be targeting. 50% is almost like a no-brainer, all right? Price will usually pull back into 50% of the range. A lot of the time it will pull right back into the full aspect of the range and maybe come up into a block, but I'll talk about it in a second. So when you're trading ranges, guys, or when you're trading voids, 50% is a good level to mark out. And what I'll do is to encourage you guys to just literally mark out the range. Use your fib tool, mark out from the high to low of the void you're looking in, and target the 50% level if you're going to trade a retracement back into that range, of course. And obviously, guys, I'm not just saying trade that as a directional premise by itself. You must see the market structure reflect that price wants higher prices or wants to fit in those ranges, all right? And that's either going to be if price comes into a block inside this range, or if it runs to lower or high, and then shows willingness or bullishness to go higher back into the range, all right, guys? But a good mark is to just target the 50% level. I'm just going to show you again. So it's the same thing over here, guys, all right? I'll show you another range as well, another void range. This is also a void, all right, guys? Why? Because it's a series of down candles without any pullback, all right? So in other words, it's the same situation we had over here, guys, except this is probably a bit more obvious because the candles are a lot bigger and the ranges are a lot bigger, which means there's going to be probably more orders in this area. So all we do is we do the same thing, guys, all right? We want to target the fair value gap, or we want to target the fair value of this range or of the void, all right? And in this situation, that would have been this level right here, all right, guys? So I would encourage you guys to mark this level out, right? Just have it marked out, and then you can delete your fib. All right. So in this situation, guys, I'll be looking at the market share of the market. If I was going to trade back into that range, I would say, okay, we've broken a low here. So liquidity's been neutralized on this side of the range. All right, guys, it's the same tactic we're using here. There's always liquidity below and above highs and lows. So when price runs out a low, then liquidity is neutralized. It's the same thing here. Price is running low. So the objective on this side of the market has already been met. All right, guys. So in this situation, that would be my next target. Because price has been neutralized liquidity on that side of the market, I would expect to pull back into this range for a short. All right. So that would have been a very good target to have. As you can see in this situation, price has not just pulled back into the range, it's taken out that high. So it filled in the entire range, which you can do sometimes also. But this is another concept of liquidity you want to use, guys, all right, in your trading. This will appear on a 5-minute, a 50-minute chart, half an hour, 30-minute chart, hourly chart. Every single time frame, it's the same concepts we're using, guys, all right? We don't change anything. The only thing is that we might have to be a bit more techie with our entries on a 5-minute time frame than this, or the levels might not hold as much, but you are using the same techniques in every single time frame you have, okay? Because price is fractal, which means that it just repeats the same patterns again and again across all the different time frames. So in this example, guys, that would be my target for this range. All right, that would be the target I'll have. And this is how, you just want to understand where liquidity is in the market, because having these levels marked out on your chart, guys, even at, your highs and your lows, having all these levels marked out on your chart, what it does, it just gives you a framework to work around. All right, guys, and that's what you need. You want a framework to work around. You want to have these levels marked out on your daily chart so you know where your targets are. All right, guys, you want to know where your targets are on a daily chart, on a 4-hour, on an hourly. It doesn't matter what type of trader you are, but you must have these levels marked out because it makes your life a lot easier in the long run. So in these situations, guys, I have my highs and my lows marked out. I have my ranges. I have my voids marked out. We've also got another void here too. All right, guys, same concept that we're using here. I would have probably just used this. That would have been my range. That would have been my void. Why? Because they're very obvious big down candles. There's no pullback into the range. It's just a consistent downward trend. All right, guys. So again, you have your range marked out there. You have your highs and your lows marked out. Price has broken the market structure. It's filled in its objective. It's met its objective on that side of the market, and it's taking liquidity. Where is the next area liquidity line? In the void and also above that high. All right, guys, so this just allows you to have good targets for where you want price to reach for. And if you have these levels marked out, again, if we go from that high to that low, equilibrium is right there, okay? Price just came shy of that equilibrium level there. So again, you have a good area to target. All right, and the more you understand these, guys, the more you study this, the more you go over this in your different time frames and on your charts, is the more you'll see it in your own trading, and the more you'll see it long term and in real time as well. Because trading isn't just hindsight, as you guys know. Eventually you will work towards seeing this stuff in real time and being able to trade it in real time also. So understanding these concepts properly and going through the price action, going through and back testing these concepts I'm showing you now, that's what's going to allow you to have a proper perspective on the market, and that's also what's going to allow you to see the stuff in real time and then, of course, make money with it eventually. So, same thing I'm doing here, guys. There's nothing special, all right? You want to just mark out your highs and lows, mark out your voids in price, all right? And the third concept of liquidity that I want to teach you guys today also is gaps. So, gaps usually will occur on Sundays at the end of the week, where price is usually just made a gap in price, and price will usually tend to fill in these gaps. I'm going to try and find one for you now. 1 minute. So, right, we have a gap here. Okay, guys? So, gaps usually occur. It's just, just see these as voids. They are more or less the same thing as a void. They're just an area of price where price is gapped out from the open and the close. All right, so that right there was a gap on the 12th of December. All right, guys. And price more or less gap down on the 1st of December, sorry, guys. And price more or less gap down into the next week. So this will usually happen on the weekend, all right, guys? But you know, when they turn off the charts and prices stalled on the weekend and the market's closed, what will usually happen on a Monday or a Tuesday, well, usually Monday, is that you will get price open like way below where it closed, or open way above where it closed, right? And in this situation, price closed around here, wicked down and ran back up into the range. It closed there on a Friday, and on Monday, that's where it opened. So we've got what, a good 25 pips of range that, you know, that has not been filled. And this just allows you guys to, you know, have areas, you know, that you can target. It's the same thing as before. You want to target these areas eventually, depending on what the market structure is. All right, guys? So I just use these areas as a target because I know there's liquidity in these areas, and the market makers will usually want to fill in these gaps of price eventually throughout the week or throughout the month. So in this situation, we had Monday's trading here. I'll split the day divider so you can see. That was Monday's trading day. And on Tuesday, we had an expansion up to fill in that gap. Now, these gaps won't always be filled, guys, all right? They won't always be filled immediately, but usually they will be filled eventually. But this just gives you another good framework to target, or another area to target that is inside the range. Okay, guys? You want to be targeting these areas also. So don't just target these willy-nilly. You want to, you know, trading is always about confluence. It's always about understanding and, you know, understanding the majority of the concepts and then using them in correlation with each other. But, you know, it's the same situation, guys. We're using these as areas that we can target alongside what we usually do, alongside our range finding, alongside our entry techniques, guys, all right? So in this situation, you can see that price expanded up into the range, filled in that gap, did not take out the high of the previous week, that high remained in, then price dropped back down into the range, into that breaker there. And then we saw an expansion. We saw an expansion up, and then that high was taken out, guys, all right? It's just a game of liquidity. All right, they're just running highs, they're running lows. You know, the market makers, all they're doing, they're just pushing price about till orders in the market are filled in. That is all they're doing. All right, guys? So don't think you need your fancy techniques, those, you know, those indicators on your screen, those, I don't even know, those weird bloody techniques, flipping back patterns, all that kind of stuff. You don't need that, all right, guys? You don't need that. You just need to understand this. You know, what I'm showing you here, understand where price is within a range, understand where the liquidity is, and that is more than enough for you to understand where price is going to be drawn to. You know, getting an entry, you know, once you know price is going to expand up to those levels, it's getting the entry, which is the hard bit, and having an entry that is inside your trade rules. That's the difficult bit, but understanding where price is being drawn to, guys, is quite a simple thing. Don't overcomplicate it, and just keep it very simple, guys. All right, that's the main thing you got to do. Keep it simple, and everything else will follow, and it'll make it much easier for you. So this is going to be the end of this module, guys. This is the 3 concepts of liquidity, Trinity liquidity techniques. So yeah, rewatch it, watch it again, and shoot me any comments you might have or any queries you have. All right, guys, see you in the next one.